Most investors focus on profits, but very few understand what actually happens after gains are realized. Capital gains tax quietly determines how much wealth you truly keep, yet it is often ignored until it is too late. Understanding this system changes how investments are timed, structured, and protected over the long term. In this video, you will learn how capital gains tax works, why it matters, and how informed investors plan around it instead of reacting later. Like and subscribe to learn how knowledge preserves wealth before it disappears. 1. What capital gains tax really is. Capital gains tax is the tax applied to the profit earned when an asset is sold for more than its purchase price. Assets can include stocks, real estate businesses, or other investments. The key concept is that tax is triggered only when gains are realized through sale. Until then, profits exist only on paper. Many investors misunderstand this and assume growth alone creates tax liability. In reality, timing and realization define taxation. Understanding this distinction allows investors to plan exits strategically and avoid unnecessary loss of capital. 2. Short-term versus long-term gains. The length of time an asset is held plays a major role in how gains are taxed. Short holding periods are often taxed at higher rates because they are treated similarly to regular income. Long-term holdings usually benefit from reduced tax rates as governments encourage long-term investment behavior. This difference significantly impacts net returns. Investors who ignore holding periods often lose a substantial portion of gains unnecessarily. Strategic patience is one of the most powerful tax reduction tools available. 3. Why capital gains tax shapes investor behavior. Capital gains tax influences when investors sell assets and how long they remain invested. Fear of taxation often causes premature selling or excessive holding beyond optimal timing. Skilled investors incorporate tax considerations into decision-making without allowing them to dominate strategy. Taxes are treated as a planning factor, not a reactive shock. Understanding how taxation affects net outcomes allows investors to align financial decisions with long-term objectives rather than short-term pressure. 4. The role of cost basis in tax calculation. Cost basis refers to the original value of an asset adjusted for fees, improvements, or reinvestments. Capital gains are calculated by subtracting cost basis from sale price. Errors in tracking cost basis can lead to overpayment of taxes or disputes. Long-term investors maintain accurate records to ensure gains are calculated correctly. Understanding cost basis protects wealth and prevents administrative mistakes that quietly reduce returns. 5. Capital gains and market timing. Taxation turns timing into a strategic decision. Selling during high-income years can increase tax burden, while selling during lower income periods can reduce it. Market conditions matter, but personal financial context matters equally. Smart investors coordinate asset sales with income cycles to optimize outcomes. This level of planning separates reactive investing from structured wealth management. 6. Capital gains in real estate investing. Real estate investors face unique capital gains considerations. Appreciation over time can create large tax exposure upon sale. However, long holding periods often result in favorable treatment. Planning exits carefully allows investors to preserve equity and reinvest efficiently. Poor planning can erase years of gains in a single transaction. Understanding real estate taxation transforms property ownership from speculation into strategy. 7. Reinvestment and tax efficiency. How gains are reinvested affects long-term tax efficiency. Reinvesting without planning can trigger repeated taxation that slows compounding. Strategic investors design portfolios to minimize unnecessary realization of gains. This preserves capital and accelerates long-term growth. Tax efficiency is not avoidance, it is intelligent sequencing of financial actions. 8. Capital gains tax and portfolio turnover. High portfolio turnover significantly increases tax exposure by forcing frequent realization of gains. Every time an asset is bought and sold, a taxable event is created, reducing the amount of capital that remains invested and able to compound. While active trading can feel productive, constant movement often erodes returns quietly through taxes rather than poor performance. Long-term oriented portfolios experience lower tax drag because gains are realized less frequently and often at more favorable rates. This allows compounding to work uninterrupted over extended periods of time. 9. The psychological impact of capital gains tax. Taxes often trigger emotional responses that quietly distort investment decision-making. The fear of paying capital gains tax can push investors into irrational behavior, such as holding on to losing positions too long, or exiting profitable investments prematurely simply to avoid realizing gains. These reactions are rarely logical, yet they feel justified in the moment. Rational investors accept taxation as a natural consequence of success and focus instead on net outcomes over time. 10. Capital gains tax as a system, not a surprise. Successful investors view capital gains tax as a predictable system rather than an unexpected penalty. Every investment decision is made with awareness of future tax implications, including holding periods, rates, and timing. This mindset transforms taxation from a perceived threat into a design constraint that informs better structure. When taxes are accounted for early, portfolios are built to minimize friction rather than react to it later. Systems that incorporate tax considerations consistently outperform reactive strategies over long periods because they preserve more capital for compounding. Capital gains tax is not just a rule, it is a silent force shaping investment outcomes long before profits are realized. Investors who understand it protect more of what they earn and build wealth with intention rather than surprise. Planning timing structure and reinvestment turns taxation into a manageable variable instead of a painful loss. Like and subscribe to continue learning how informed strategy preserves wealth over the long term.